Hey everyone, and welcome back to the channel. Today we're diving into a topic that might sound a bit intimidating at first, but is super important for any company looking to go global with its financial reporting. We're talking about IFRS 1, which stands for First Time Adoption of International Financial Reporting Standards. So, what exactly is IFRS 1 and why should you care? Imagine a company that's been using its local accounting rules, let's call them local GAAP, for years. Now, this company decides it wants to list on an international stock exchange, or maybe it's been acquired by a global giant that uses IFRS. This is where IFRS 1 comes into play. It's essentially the rulebook, the how-to guide for making that big switch from your local accounting standards to the internationally recognized IFRS. It's not just a simple translation, it's a complete transition. The goal is to make sure that the company's very first set of IFRS financial statements is high quality, transparent, and comparable to all the other companies out there already using IFRS. The main objective of IFRS 1 is to provide a solid starting point for a company's IFRS journey. It aims to create financial statements that are not only transparent to users like investors and creditors, but also comparable over all periods presented. Think about it. If you're an investor, you want to be able to look at a company's performance this year and compare it to last year on a like-for-like basis. IFRS 1 ensures that happens smoothly. Plus, it provides a suitable starting point for accounting under IFRS that can be generated at a cost that doesn't exceed the benefits. In simple terms, it's designed to be practical and not ridiculously expensive to implement. Now, let's get into the nitty-gritty. How does this transition actually work? The core principle of IFRS 1 is that a company must prepare an opening IFRS statement of financial position. This is like hitting the reset button. This opening statement is prepared at what's called the date of transition to IFRS. This date is the beginning of the earliest period for which the company presents full comparative information under IFRS. For example, if a company is preparing its first IFRS financial statements for the year ending December 31st, 2024, and it needs to show 1 year of comparative data, its date of transition would be January 1st, 2023. That's the starting line. On this date of transition, the company has to do a few key things. First, it must recognize all assets and liabilities that IFRS requires. This might mean adding items to the balance sheet that weren't there under local GAAP. Second, it must not recognize items as assets or liabilities if IFRS doesn't permit such recognition. This means some things might get taken off the balance sheet. Third, it needs to reclassify items. Maybe something was classified as an operating lease under local GAAP, but IFRS 16 treats it as a finance lease. That needs to be changed. And finally, the company must apply IFRS in measuring all its recognized assets and liabilities. This often means remeasuring items to fair value or another IFRS-required basis. all the adjustments that arise from this process, from moving from local GAAP to IFR, are recognized directly in retained earnings, or another category of equity if that's more appropriate. This is a one-time cleanup to get the books aligned with IFRS principles from day one. Of course, a full retrospective application of every single IFRS standard for all past transactions could be incredibly difficult, if not impossible. Imagine trying to find the fair value of an asset you bought 20 years ago. That's why IFRS 1 provides some relief. It has mandatory exceptions and voluntary exemptions. Mandatory exceptions are things you must do. For example, the rules for derecognition of financial assets and hedge accounting are applied prospectively from the date of transition. You don't go back and change past transactions. Then there are the voluntary exemptions, which are optional reliefs a company can choose to use to make the transition easier. A big one is the deemed cost exemption. Instead of trying to reconstruct the historical cost of property, plant and equipment, a company can choose to use its fair value at the date of transition as its deemed cost going forward, or it could use a previous revaluation amount under its old GAAP as the deemed cost. This saves a massive amount of time and effort. There are several other exemptions related to things like business combinations, employee benefits, and currency translation differences. The key is for the company to carefully evaluate these options and choose the ones that make the most sense for its specific situation. Finally, let's talk about disclosure. Transparency is key. A company adopting IFRS for the first time must explain how the transition from its previous GAAP to IFRS affected its reported financial position, financial performance, and cash flows. This is usually done through detailed reconciliations. There's a reconciliation of equity from previous GAAP to IFRS at the date of transition, and another one at the end of the latest period presented in the entity's most recent annual financial statements. There's also a reconciliation of total comprehensive income. These reconciliations are crucial for users of the financial statements to understand the impact of the change in accounting policies. So, to wrap it all up, IFRS 1 is the essential standard for any entity making the move to international financial reporting standards. It sets out the procedures to ensure that the first IFRS financial statements contain high-quality information that is transparent, comparable, and provides a suitable starting point for future IFRS reporting. It's a complex process, but the standard provides a clear framework with practical exemptions to make it manageable. I hope this overview of IFRS 1 was helpful. It's a foundational standard for global business. If you found this video useful, please give it a thumbs up. And don't forget to subscribe for more deep dives into the world of accounting and finance. Let me know in the comments if you have any questions or what topic you'd like to see next. Thanks for watching, and I'll see you in the next one.